15% yield at Swissborg on stable dollar coins, 12% at crypto.com on a range of currencies. Finally, a small 5% at Binance, but you will note that the principal is noted as being guaranteed. But by whom and how? And if you have a more artistic profile, you can find returns of over 1,000% on some of the more creative cryptos that I won't mention. As a financier, of course, these hedge fund-like returns are of great concern to me. So let's see if cryptos have found the magic formula to make us all rich, or are there significant risks that we tend to underestimate? Come on, let's go. Basically, no matter what project we're talking about, and especially in finance, the big questions to ask are always the same. What's the point? How does it help, and to whom? When you lend money, you need to know what the money will be used for. In the case of our interest rates, who is going to pay the 5 to 12% that I showed you in the introduction? First essential thing to know, in cryptocurrency, all the loans that are made are pledge loans, collateral, or even Lombard loans. There are several formulas of a well-known type of loan, a trustless loan, the loan against collateral. More clearly, if you want to borrow $100,000, the lender who doesn't trust you and wants to limit his risk as much as possible will ask you to put something worth $150,000 in escrow. For example, you go to a pawn shop with your luxury watch, which the pawn shop estimates is worth $10,000, and the pawn shop agrees to lend you $5,000 at a rate of 10% to keep it simple. The contract is simple. For a loan where you agree to pay back within a year, if you come back with $5,000 plus the agreed upon $500 interest, then he gives you your watch back. So after a year, you have to give $5,500 to get your watch back. If you don't come back, the pawnbroker sells your watch for $10,000 and gives you the difference back. $10,000 minus $5,500 minus a fee. In this type of loan agreement, whether you pay it back or not, the lender never loses. Trust does not come into play because there is collateral, in my example, the luxury watch, that assures the lender of not losing money. All loans on crypto in the DeFi world for decentralized finance work with trustless loans. The pawnbroker is replaced by smart contracts that act automatically. These are programs that operate from the blockchain and the collateral. The watch, in the crypto world, these are various and diverse cryptocurrencies. So for a crypto loan, if you have 10 bitcoins worth $400,000 and the collateralization ratio is 100%, you can borrow for $200,000 in another cryptocurrency of your choice. What is interest? There are 4 that I have identified, 2 of which are major. One of the 2 most important is to leverage the Bitcoin price. I have 10 bitcoins and I think the price is going to go up, so I'm willing to borrow to buy more today because I think I'll sell them for more tomorrow. I put my 10 bitcoins as collateral, and with it, I borrow $200,000 worth of stable coin, USDT. A stable coin is a crypto that is supposed to have a stable value. In this case, the USDT copies the dollar. With my 200,000 USDT, I buy Bitcoin. Luckily, Bitcoin takes 50%. I have $300,000 worth of Bitcoins and I sell them so I can pay back my 200,000 USDT. So I've earned $100,000 on my USDT I borrowed, and I've also earned 50% of my $400,000 of collateralized Bitcoin that I get back when I repay my loan. Conversely, what happens if Bitcoin falls by 50%? In this case, my $400,000 of collateral becomes $200,000, and I'm in a critical threshold where my collateral is worth my loan. In this case, the smart contract sells your Bitcoins as collateral and automatically pays off the loan without asking you. You are locked in and owe nothing more. You keep in your possession the crypto you borrowed. If you kept the USDTs, you have $200,000, so you lost 50% of your capital, and if you bought Bitcoin with your USDTs to leverage, you lost $300,000 of your $400,000 initial capital because your borrowed Bitcoins were divided by 2. Bad luck. So you see, the first use is speculative. This is neither good nor bad, but the high interest rate is due to a sharp rise in Bitcoin. Since Bitcoin has historically grown by 150% per year, speculators don't mind paying 15% interest. Moreover, If you go directly through decentralized exchange platforms, you can have rates higher than 15%. So, in terms of usefulness on this first use case, it can be understood. We earn money by lending USDT to speculators. What are the risks for the lender who does not speculate but gives the temporary ownership of his crypto to a third party? In theory, none. In practice, traditional finance is full of bad experiences. First risk, the intermediary who operates the loan is failing. In the case of the pawnbroker, let's say he leaves with a $10,000 watch without asking you if you want to pay it back. In the case of crypto, there is a technological risk on the smart contracts, which are only programs that can be bugged or that can contain what is called backdoors that allow the creator to get his hands on the loot in a fraudulent way. This type of risk can be seriously limited if you go through intermediaries who have a good reputation and who deal with large volumes. That's why I gave you the names of Binance, Swissborg, or Crypto.com, which are 3 reputable companies. If you want to go and see, I put some affiliate links in the description to get some advantages. Then you have a structural risk in the markets, the price drop. For example, if the smart contract has to sell your collateral when it is 10% above the value of the loan, and the price suddenly drops by 20%, then the contract will be executed at 10% below the value of the loan. In this case, it is the lender who is harmed because the borrower will prefer not to pay back. In traditional finance, when this happens, and it happens regularly, as a borrower, you owe the bank the shortfall and the bank will not fail to sue you to recover the money. In DeFi, I don't think you have that recourse. Moreover, that's why Binance offers rates with or without a guarantee. You will notice that interest rates on loans with a guarantee are much lower because it covers the risk. So don't think that lending your money on decentralized DeFi exchange is risk-free. In short, you have the technological risk of a bug in the programming of the smart contract or the security of the platform, the market risk with price drops. Don't forget that in the event of a crash, everyone is looking to sell, and as Bitcoin is 7 transactions per second, not everyone will be executed. The same with different numbers depending on the blockchain involved. The possibility of running the legal risk, since nothing is guaranteed by the law regarding cryptocurrency. Then the second major reason for the high interest rate, tax evasion. You are not without knowing that the capital gains in cryptocurrencies are taxable. The taxable event is the resale of a cryptocurrency in a state currency, or the purchase of a good or service. So, if Bitcoin has doubled in value, and you buy your baguette at €1 in Bitcoin, you owe 15 cents of tax on the capital gain at the end of the year. Good luck doing the math. On the other hand, what is not taxable are the exchanges between cryptocurrencies. If your Bitcoin has doubled and you convert them into DAI or USDT, you have stabilized your capital gain, but you don't owe anything to the taxman because the DAI or USDT are cryptos, although indexed to the dollar. Another thing, if you have 10 Bitcoins or $400,000 and you want to buy a house for $200,000, you can borrow that $200,000 at 15% in USDT. With these USDT that you borrowed, you don't realize any capital gain, so you turn it into dollars and buy your house. When you do it through a loan, it works. There you go, you have a house. You still have your Bitcoins and you don't owe taxes. The interest rate is 15%, which is very expensive, but if Bitcoin collapses, you would be locked in and you keep your house. And if Bitcoin continues to rise at a rate of 150% per year, you don't care about the 15% interest. These are the 2 reasons, speculation and tax evasion, why stablecoins are so well paid. Afterwards, in practice, the exchanges also aggregate other mechanisms to obtain these rates, such as mining on blockchain in proof of stake or the valuation on the markets of the over-collateralization, but it seems to me a minor part of these remunerations. Finally, beware, as if it's the plague, of offers of very high interest rates at several tens or even hundreds of % on fake crypto in the form of fruits and vegetables or fish, because there are really mechanisms close to the Ponzi that are at work. If you want to test it, do it while being aware of the intrinsic risks on the big crypto and on well-established platforms, because otherwise you take much greater risks. On that note, thanks to Michael Kazaka who enlightened me on this subject, and see you soon for new videos. Ciao.
Thank you so much for watching. If you like my videos, please subscribe and don't forget to hit the bell if you want to be notified of the next episode. And if you want to invest in the stock market over the long term or diversify your financial portfolio, I'm offering you an analysis of the 8 European star stocks to have. Thanks again for watching and have a great day.